Ladies and gentlemen, good day and welcome to V2 Retail Limited Q1 FY'25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. The presentation which V2 Retail Limited has uploaded on the stock exchange and their website, including the discussion during this call, contains or may contain certain forward-looking statements concerning V2 Retail Limited business prospects and profitability, which are subject to several risks and uncertainties, and the actual results could materially differ from those in such forward-looking statements. Ladies and gentlemen, I now hand the conference over to Mr. Akash Agarwal, Whole-Time Director, V2 Retail. Thank you, and over to you, sir.
Good afternoon, everyone. A very warm welcome to our Q1 FY'25 earnings conference call. Along with me, I have Mr. Manshu Tandon, our CEO, and Marathon Capital, our investor relations team. I hope everyone has had an opportunity to look at our results. The presentation and press release have been uploaded on the stock exchanges and our company's website. At V2 Retail, our mission is to democratize fashion by offering high-quality, trendy apparel at affordable prices to value-conscious customers across all tiers of cities. We achieve this through operational excellence, strategic expansion, competitive pricing, a customer-centric approach, and a strategic use of technology. Our diverse product range, competitive pricing, and exceptional shopping experience ensure that we provide significant value to our customers. As we continue to grow and innovate, we remain committed to making fashion accessible to all, uplifting communities, and driving sustainable growth. Our business model has increasingly evolved to deliver desirable customer propositions. The emphasis on our own designing and credible quality, nimble responsiveness to emerging consumer preferences, coupled with relative price stability, contributes to our distinctive market positioning in the value retail apparel space. Let me start with some key updates. After a historic FY'24, we are thrilled to start the current financial year with the highest ever quarterly sales during Q1 and a 162% increase in year-on-year PAT. The company opened 10 new stores during the quarter, taking our total store count to 127 stores. Our store expansion strategy is focused on penetrating underserved urban and rural markets and maintaining a strong presence in Tier 1 and Tier 2 cities to reach a very diverse customer base. We aspire to add between 50 to 60 stores on a net basis through internal accruals in line with the commitment to sustainable growth driven by cash flows in FY'25. The strong acceptance of our differentiated product offerings at full price is the testimony of our customer-centric thinking of providing fresh variety, good quality at best price. So the growth across all our stores have been encouraging, translating into a robust same-store sales growth of 37% in Q1. We have been able to consistently deliver high double-digit SSG for the last few quarters due to this approach. The volume growth was 55% in the first quarter. The full price sales contributed 93% in the first quarter compared to 84% in the corresponding quarter last year. Through efficient supply chain management, streamlined operations, and strategic inventory management, we have been able to maintain cost effectiveness without compromising on quality. We believe that our sustainable and scalable business model will help us improve ROCE and ROE going forward. Now I will hand over the conference to Mr. Manshu Tandon, our CEO, to give you an overview of our operational performance during the quarter.
Good afternoon, everyone. So I'll give you a brief on the consolidated performance highlights for Q1 FY'25. So revenue from operations stood at 415 crores, registering a growth of 57% on YOY basis. Gross margin stood at 29% for Q1 FY'25, EBITDA for the quarter stood at 55.5 crores as compared to 35.6 crores in Q1 FY'24, registering a growth of 56% on YOY basis. EBITDA margin stood at 13.4% for Q1 FY'25. PAT for the quarter stood at 16.3 crores as compared to 6.2 crores in Q1 FY'24, registering a growth of 162% on YOY basis. As on June 30th, 2024, the company operates 127 stores with a total retail area of 13.64 lakh square feet. The company opened 10 stores in Q1 FY'25. So with this, I now leave the floor open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankush Agarwal, Surge Capital. Please go ahead.
Yeah, hi sir. Thank you for taking my question. Firstly, what kind of pre-Ind AS EBITDA and PAT margins are we looking for FY'25 and for the coming years?
So if we talk about pre-Ind AS numbers, this year we are targeting an EBITDA of 7 to 8%, and going forward we want to target a pre-Ind AS EBITDA percentage of 8 to 9%.
Okay. And how much would that translate to net margin, like on a PAT basis?
So I think in FY'24 our net margin was about 3.5%. So you can expect this year's PAT margin to be 4.5%, and going forward it should be between 4.5 to 5.5%.
Okay. Secondly, can you share the share of our own proprietary labels and own manufacturing for FY'24, and how should we see that number going ahead?
So our private label contribution is almost 80%, and going forward the target is to make it 100% private label business. So we are moving in that direction because 1 year back that percentage used to be 60%. So in 1 or 2 years we want to be 100% private label business.
Just a clarification, till FY'23, based on the annual report, the revenue share from proprietary labels was 40% in FY'23. This is as per the annual report. So when you say private label and proprietary label, is there a difference in that, or that number has moved from 40 to?
No, so you're talking about financial year. I was talking about calendar year. That is why there's that confusion. So this year when I mean from January till July, the percentage is 80%. So if you convert it to financial year, I think it was 40%, then 60%, and this financial year we close at 80%, and in one or 2 years we plan to take it to 100%.
Okay, got it. The last question is on the gross margin. So over the last couple of quarters, we have seen gross margins taper off a little bit every quarter. On one side, you have continued to maintain that you are trying to pass more value to your customers. But on the other hand, what is also true is the share of revenue from proprietary labels have increased. The share of sales from at MRP has also consistently increased, so which should add to gross margins. So from all this perspective, where do you expect this gross margins to settle eventually?
So we pass on all the benefits from our own production as well as private labels to the customers. So we do not get an extra gross margin on our private labels, and we are selling more at full price. But now our input margin strategy is such that we are targeting a gross margin percentage ranging from 27 to 29%, because we want to give maximum value to the customer and we want to be the market leader in the value fashion space.
Got it. That was very helpful. Thank you.
Thank you.
Thank you very much. The next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
So I hope I'm audible. Congratulations on very good set of results, and thank you for the opportunity. Sir, my question is related to market leader in our category, which will be Zudio. So do you foresee your store metrics going closer to Zudio in coming years? And if yes, then what are you planning to do to, like, take it closer or, yeah?
So there are two major metrics that we look at and we focus on. Rather than just per square feet sales or per square feet cost or GP per square feet, we focus on EBITDA percentage, which is pre-Ind AS EBITDA percentage, and the ROCE and the ROE of the business. So going forward, our aim is to, be at par or even be better than the best players in this space. So that is why I said going forward, we want to keep increasing our EBITDA margins pre-Ind AS and move to 9% first and then further.
Okay, sir. And sir, did I get you correctly that you are planning to add 50 to 60 net stores this year?
40 to 50.
Acha, okay, 40 to 50. Okay.
We have already added 10 stores, and the plan is to add about 30 to 40 more.
Okay. Got it, sir. Thank you. And so my next question is, if everything goes right in like next 2-3 years, so what is that opportunity in front of us in terms of store addition? What do you see that room for expansion in next 3 to 4 years for V2 Retail?
So it completely depends on the performance and the execution and, how the new stores that we are opening are doing. If we continue to see the kind of growth that we are seeing and the kind of product acceptance that the market is showing us, then after this 40 to 50 stores this year, we might open another 60 to 70 stores next year. So it all depends how the business is performing, because we don't want to chase just growth by compromising on profitability. So the first target is for the next 3 to 4 years to grow at least 30 to 40% in both in terms of revenue and EBITDA.
Got it, sir. Got it. And sir, what was our footfall growth for the quarter?
I'll have to check the exact number, but we started tracking footfalls from this year because old technologies were not accurate enough to be relied upon. So we will be able to give the comparison of footfalls from next year onwards, because we started collecting that data, I think, about 5 months back.
Thank you for that. That's it from my side, and all the best for future.
Thank you.
Thank you so much. The next question is from the line of Jagvi Singh from Shade Capital. Please go ahead.
Yeah, thanks for the opportunity. So, sir, what is the current debt position?
So I think the current debt on the books is about 78 crores. So what we have is, it's a CC limit that we have from the banks, and we give a bill discounting feature to all our vendors where they can get an early payment of their bills. So mostly we use the limit for those purposes.
Okay. Yes, sir, second question related to the competition. So Zudio is, I think, at upper level because they start from 450 or 500 rupees. So is this Vishal Mega Mart or V-Mart?
So there are different tiers of competition. So one would be the local mom and pop stores, which is the unorganized retail. One is the national level retailer. So there is a certain level of overlap because Zudio starts selling their t-shirts for 199, but their ASP is almost 80% higher than ours. So there is competition from each space, I would say, whether it's Vishal, V-Mart, Zudio, but we try to focus on ourselves. And I think in India, the market is big enough to easily accommodate 5-6 big national players, because the shift from unorganized to organized retail is accelerating, and that is how the organized retail is going to grow at a high CAGR for the next few years.
Okay. And sir, second question related to the manufacturing. How much is owned manufacturing?
So about 16% of our sales are own manufacturing, but we don't plan to open any 16. But we don't plan to add any more units. So as we are opening more stores and as our sales are growing, this contribution is going to come down.
Okay. So sir, in the first innings in the Vishal Mega Mart, I think inventory issues has the problems. So what we have learned from them, and so what is our strategy for in this new inning?
So one of the biggest learnings was not chasing growth blindly by compromising on profitability. So we make a store level EBITDA every month. We sit down, we take decisions on slow moving, low performing stores. And I think in the history of V2, it's the first time that not even a single store is EBITDA negative on a YTD level with the corporate cost. So like we try to forecast cash flows, EBITDAs, and we try to keep certain business metrics in check before taking the next leg of expansion. And if you talk about learning, there have been 15, 20 learnings. This call will go on. But we have learned from those mistakes and implemented a lot of checks and balances in order to not open bad stores. So there's a lot of checks before finalizing a new store. There's a lot of checks on inventory control. Our old and aging inventory has come down drastically. So I think everything points towards a very positive outlook.
Thank you very much, sir. This is from my side.
Thank you.
Thank you. To ask a question, please press star and 1 now. The next question is from the line of Abhishek from ABS Capital. Please go ahead.
Hello, am I audible?
Yes.
Yes, sir.
Yes. You said that ROE will increase going forward. Can you throw some light as to what ROE number you are targeting internally going forward?
So the ROE number that we're targeting going forward should be around 20 to 22%.
Okay. And going forward, how much same store growth do you target internally? Can you give some
So
number?
I think 10% is a very good number. So going forward, even if we achieve a 10% SSG, I think that's very good for the business because it's a fixed cost business where even if you grow your sales by 10%, your profitability grows multifold. So going forward with a higher base, I think even if we get 10%, a double-digit SSG is a good SSG.
And just one clarification, in the long term, just now you told that revenue growth you are targeting internally is around 30 to 40% year-on-year, right?
Yes.
Thank you. Excellent set of numbers. Thank you.
Thank you. The next question is from the line of Srinjana Mittal, Ratan Tarya Capital. Please go ahead.
Hi, thank you for the opportunity and congrats on a good set of numbers. So I have 3 questions. One is on the employee cost. So this quarter, the employee cost is little bit on the higher side. So I wanted to understand that is it because of some increments, some incremental cycle, or is it just new employee addition? Can you throw some light on that?
So most of it is because of the new store additions. So a lot of the hirings needs to be done at least a month or a couple of months prior to the opening of the store. So every quarter, we plan to open 15 to 20 stores. So if you look at the per square feet basis, there's not much change. But in the absolute numbers, as we keep growing the store base, this number will rise.
Understood. And on the one question on the same store sales growth. So how do we calculate our same store sales growth? Like in the denominator, do we include stores which are greater than 1 year old as of date, or what is the argument for that?
Yeah, we include all the stores that existed till 31st of March 2023.
31st of March 2023. That is for this year's same store.
That is for quarter 1 SSG, because all the stores should have been there for the whole quarter of 2023 as well as 2024. That is the only criteria. So the stores that opened during the first quarter of FY'24, we don't take that. It's only the opening number of stores. Yes.
Understood. Okay. Just one more question on the seasonality. Can you give some color? So I understand that Q3 is a bigger quarter for us, but Q2 also relative to Q1, it's a little bit on the slower side, even in terms of margin. So why is that? If you can just give some color on that.
Yeah. So Q1 and Q3 are the biggest quarters for us because Q1 is the main wedding season and the summer season, and Q3 is the festive and the winter season. And Q2 has July and monsoons and even Q4 has January and February, which is end of season for winter and pre-winter. So that is the seasonality impact in retail. But I think going forward, all our quarters will be EBITDA positive.
Understood. Thank you. Thank you for taking the question. All the best.
Thank you. The next question is from the line of Kaustav Pawaskar from Sher Khan by BNP Paribas. Please go ahead.
Yeah, good afternoon, sir. Thanks for giving me the opportunity. So my question is on gross margins. So just want to understand the decline in the gross margins in this quarter, and how do you see this, going ahead, considering the fact that Q3 is one of the strongest quarter for us. So whether this quarter has some impact of mix or discounts, which impacted the margins, which will not be there in the next quarter. So just understanding from your end.
Yeah. So in fact, there were lesser discounts, but still there's a decrease in gross margin percentage because, like I said, it's the strategy of the company. We are not focusing on gross margin percentage, rather than we're focusing on EBITDA percentage. So if we reduce our gross margin by 10% and that increases our sales by 15-16%, so that is ultimately beneficial for the business. So it's a business strategy, and going forward, we are targeting a gross margin of 28-29%.
Okay. Okay. And so I just wanted to understand how the demand environment is like, how it was last year compared to that, how the demand environment is in, some of the important states where stores are, and how the festive season would be for us where, maybe quarter three, because last year quarter three was much, much stronger for us. So considering that, how do you expect this year's festive season?
So if you talk about the demand scenario, I think the 37% SSG, the number itself says a lot, and we have seen this consistently over the last 4-5 seasons. And now it's very hard to differentiate how much of that is because of our own strengths or, the work that we have put, or how much of that is the overall market growing. But we have seen an amazing demand, and for quarter three, we hopefully want to continue the momentum. And, we are working hard towards that. And I think this trend should continue, and because we are getting a very good feedback from our customers, both about the price proposition as well as the product offering. So I think this is a trend that should continue in the future quarters.
Okay. Thanks.
Because we have seen this in July also. So in July, our same-store sales growth is actually better than the Q1 numbers.
Oh, okay. Okay. Thanks for the answer.
Thank you. The next question is from the line of Ankit Babel from Shubhkam Ventures. Please go ahead.
Yeah, good afternoon, Akash, and congrats for a good set of numbers. My first question is on your working capital. So what was the inventory and creditor levels at the end of June quarter?
So if you look at the standalone basis, the inventory days were 81 days and the payable days was 40 days. So our net working capital in days were 42 days.
No, I need the absolute numbers at a consolidated level.
You need the absolute. Okay, so the absolute consolidated level inventory was 439 crores.
439 crores, okay.
And the payables was 251 crores.
251 crores.
Yes.
Okay. And also as you said that the aging of your inventory has reduced a lot. So just for my understanding, what would be the share of inventory which is more than 1 year old and what it was, say, a couple of years back, just to see what kind of improvement is there?
So a couple of years back, more than 1 year inventory was almost 23%.
Okay.
And now that number is down to 7%.
7%?
Yes.
Okay.
And the idea is to take this number down to 0 by end of next year.
Great. Okay. And what are your plans for the upcoming festive season? I mean, what are your expectations?
We don't share our internal expectations because we are very bullish because every month, the growth and the demand and the customer acceptance is surprising us positively. But like I said, we always give a forecast of 30 to 40% revenue and EBITDA growth. I think this year is the same.
Okay. Okay. And just a clarification on your sales promotion expenses. Now, just wanted to understand, for the accounting treatment, do you reduce it from the revenue or show it as a part of your other expenses?
So it depends on the kind of marketing expense. So if we are doing, for example, a newspaper ad, or we are spending on ATL and BTL, those are a part of expenses. But most of our marketing spend is in terms of gifts given to customers or special discounts on some items. So that is all part of the cost of goods sold. So that is already a part of the gross margin.
No, but you show it by reducing it from the revenue, or you show it by adding it to your raw material cost? How you account it?
So it's added to revenue also, and it's added to the cost of goods sold also.
Okay. Okay.
Yeah.
Okay. And last question is, you mentioned that you want to increase the share of private label to almost 100% in the next 2 years. How is it going to benefit you? In what terms? I mean, either on the profitability or on the churning of the product, or how is it going to help you?
It's just that the customer starts identifying with the brand. So each brand will have their own story, and each brand will have their own identity. And in 2 years, each of our brands will, have a turnover of almost 200, 300 to 500 crores. So it becomes a brand in itself, and then the customers have size standardization, and they have that trust, so that whatever product they're buying of that brand will be of a certain quality or a certain standard. So that is the only benefit that we get.
Great. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Naveen Baid from Nuvama Asset Management. Please go ahead.
Thank you for the opportunity. I just wanted some sense on, what is going to be the marketing spend, X of the gifts that you mentioned will get clubbed with your COGS and revenue. What is going to be the marketing spend X of that as a percentage of the top line?
Your voice is not clear. I just understood what's the marketing spend. I didn't understand anything else.
Correct. That's correct, sir.
So it's less than 1% of total sales.
Okay. Is it going to be around similar levels?
Yes.
Okay. Thank you.
Because we have understood that the product is the best brand ambassador, and there's a lot of word of mouth marketing that's happening, because all this growth is actually, we have reduced our marketing spends from previous years. So that is why the main focus is on improving the product offering and giving it at the best price possible.
Sure. Thank you.
Thank you. The next question is from the line of Himanshu Shah from Dolat Capital. Please go ahead.
Hello.
Yes, sir.
Hello. Yeah. Hi, Akash. Heartiest congratulations on very strong set of numbers and last 18 months performance. Couple of questions. One, the store additions that we are targeting for, will it be in the existing areas of operations, or it would be coming from newer geographies? We are trying to tap newer states.
So this 40 to 50 stores that we're opening this year, like most of it is in the similar clusters or the same states that we're already present in. But maybe in the next leg of growth, we will have to enter new markets. But currently, it's all the same states and the same clusters that we're already present in.
Okay. And secondly, how much more juice has been left from a revenue per square foot? Can you give an idea what top 20% of the stores, what kind of throughput they must be doing on an annualized basis?
Like, I would not want to share those numbers, but I would tell you that we have a lot of stores that are doing above 1,400, 1,500 rupees per square feet monthly sales also. So there is no potential. It all depends on the kind of execution and the kind of product assortment that you have in the stores. Because in terms of capacity, it's huge, and it all depends what percentage of the target market that you're present in are you actually catering to. So if you have a very strong brand and you've been able to stay in touch with the latest trends, because with our markdowns and the markups, nobody can beat us in price. So it's all about product assortment. So I think that problem is not a problem till we reach maybe 2x or 3x of where we are right now in terms of per square feet of sales.
2 to 3x you're saying. But right now, some of the stores would be at around 1,500 is where you are, what you are highlighting, the top performing stores.
Yes, and even they are growing at almost the same growth as the numbers that we're posting. That is the beauty.
Okay. So on a per square foot basis, you are saying that at optimal level, the number can even double from here on over the
If we do everything right, of course.
Okay. And on rent part, how are the rent cost and what kind of escalations we are seeing over there? And is our model more of a variable or it's on a fixed rental basis with our landlords?
So it's completely fixed rental basis, and our rental costs are 54 rupees per square feet. And I think it should be at this level, just accounting for inflation, obviously, but it should remain at similar levels. We're not seeing a big change.
Okay. That's it from my side, and heartiest congratulations and all the best for the upcoming quarters and years to come.
Thank you.
Thank you very much. The next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, sir, and thanks for taking my question. Pardon me for my ignorance. I have not been part of previous calls for the company. Just wanted to understand this same-store sales growth a little bit in detail. So you've done 31% in FY'24. This quarter is 37%, and you said July has also been strong. So firstly, when I look at other companies, especially since FY'24, it has been a very tepid consumption environment, and especially in the lower income segment. Plus, competition has also intensified in the value fashion segment across the board. So, I mean, this 37% growth has continued for you. So, what are the drivers here?
So, I would say the commentary about the whole market situation depends on who you're talking to, because I know a few retailers myself who are, showing good numbers and showing good growth. So, like I said, it's all about the kind of execution that we have done, and it's the hard work of the last 3-4 years, because we were in a consolidation phase. As you can see, like, we didn't open a lot of stores, we shut down a lot of loss-making stores, we completely changed the approach to business where, it was not a product-first approach. So now we have been focusing on product, and I would say this growth has been driven primarily by product development, where like till 2 years back, only about 5% of the goods in our stores were designed in-house, whereas now that number has almost reached 30-35%. And going forward, we're targeting this number to reach 80%. And in this 30 to 35%, we are seeing at least a 20% higher throughput or per square feet sale, you can say, than the designs that we get from the vendors. So if I start listing down the things, it will be like a long list. But I would say it's completely the main driver behind this has been product, the focus on product.
Got it, sir. That's very detailed. Just a follow-up here. So you're also saying that sales per square feet potential itself is 2 to 3x from current levels, but your SSS growth guidance that you mentioned is 10%. Now, that again raises the question that from a 37%, why will it go down to 10% if the SPSF juice itself is there to be exploited?
So when we closed last year at, I think, 29 or 31% SSG, even this year we had targeted a 15% SSG, because we thought it's a higher base now. Even if we grow at 15%, so that's why I said we are positively surprised. For this year, we are still targeting a higher SSG, but when I said 10%, that was from next year onwards. So even if we close this year at 950 to 1,000, even if we are growing 10%, then we are growing 100 rupees per square feet next year. So we can easily, double in I think 5 years.
So given the way the first quarter has gone by, would you want to revise that guidance?
Again, I would not want to revise the guidance for next year. We have already revised the guidance for this year, the rest of the 9 months. But if you talk about next year onwards, we are happy. We want a minimum SSG of 10%. Any double-digit SSG is good enough for us.
And the next 9 months, you're saying 15%?
Yes, 15 to 20%.
Got it, sir. That's all from me. Thanks.
Thank you.
Thank you. The next question is from the line of Mr. Manoj from Kiva. Please go ahead.
Hi, sir. Thank you for the call and the opportunity. First, I wanted to ask, sir, will we do the call now every quarter? And also, I wanted to congratulate you for a great performance.
Yes, now we're going to do the call every quarter.
Right. And we, if I'm not wrong, we had implemented SAP HANA way back in 2017.
No, we had implemented SAP, but we have implemented HANA, I think, in 2023 to 2022.
Okay. And can you share, has that been very helpful, one of the things, and are we looking to improve the metrics there with the number one player? Are we putting more work there? Is that helping? Is that one of the secret sauces for you in the last few quarters?
No, first, can you repeat your question? You spoke about SAP HANA and then your voice broke.
Like, has that been one of the secret sauces for us? And are we looking to benchmark? So I know the largest player, Trent, they use SAP HANA very effectively. Are we trying to benchmark with them?
We are not benchmarking with anyone, so we are directly in touch with SAP and we are benchmarking with the industry best practices, and we are spending constantly. And I mentioned in my opening statement also that technology is a big part where we want to innovate and create some sort of differentiation. So there's a lot of development that's happening. So we have an SRM, we have a store app. So there are many projects that are happening and that are being implemented across. So I think we will see the benefit of that going forward. But if you talk about SAP HANA, it's just a database change that the data has been moved from Oracle to a HANA database. So obviously the reporting is faster, the extraction of data is faster. So we have better MIS and more efficient DC operations. But only that cannot be the secret sauce behind this growth.
Then can you explain you said 30-35% is the in-house design products and private label is 80%. So what is the difference between the two?
So the rest are the designs that are shown, they are developed by our vendors. So they give us a presentation and then we order it in our private labels, in our in-house brands.
Okay, got it. So then if you can just share your thought on a bridge, like you said, 1,400 square feet monthly sales versus I think 1,081 is the average company. So if you can just share the bridge, as you said, in 5 years we should go to like 2 times that. So can you just share some broad thinking if you've not already shared?
So first target as a company for us is to reach 1,000 rupees per square feet of sales yearly. So that is the target for this year. Then the next target will be 1,200. Then the next target will be 1,500. So the timelines again will depend how good we are and how good are we to actually execute our vision, because the vision is there. Now it's all about execution.
Got it. Then the new stores are starting in the same few months as they mature, how long they take, and how what sales per square feet do they start at?
So new stores typically start at a 20% lower PSF than old stores, and it takes about 12 to 24 months for any new store to mature.
Right. So thank you so much and all the very best.
Thanks a lot.
Thank you very much. Just a reminder, participants are requested to use handsets while asking a question and avoid any background noise and disturbances. The next question is from the line of Ankush Agarwal from Surge Capital. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. So the question is relatively similar to what the last participant was asking. So you said the new stores start at 20% lower sales per square feet and then they mature over 12 to 24 months, right?
Yes.
And once that happens, typically, what kind of growth is there? Like historically, what has been the growth? Because my understanding of the value retailing as a format is that initial 1-2 years of growth is there, then there's a lot of, say, a sign of saturation that reaches a particular store versus, say, some of the other retailing categories when the store starts very low and then scales up over, say, a couple of years?
I'm sorry, I did not understand the question because the 37% SSG that we have shown, it has all the old stores as well as the new stores, till the stores that had opened till March of 2023.
Yeah, obviously. I mean, currently, the kind of traction that you're getting is incredible. Generally, at a value retailing at an industry level, I'm trying to understand the journey of a store. Like, what we said makes sense that initially, I think in 1.5 years, you are typically reaching at a steady state mature level. But beyond that 1.5 years, what's the growth part for a typical store? Like, is it like, do you still get 10% SSG or it's like 5%?
So if you look at the consolidated number, yes, it will be around 10%. That is what we're targeting. But if you take out samples, then of course there are some stores that do 25%, there are some stores only do 2 to 3%. So those outliers are always there, but I think there is no, I would say, directional change, or there's no change in the trend of a new store versus a new old store in terms of growth. Because once the store matures, it acts pretty much like an old store.
Got it. Got it. Okay. Thank you. That was...
Thanks.
Thank you. The next question is from the line of Madhav Agarwal from SG Investments. Please go ahead.
Hello. Hope I'm audible.
Yes, sir.
Hi. Could you give a breakup of the sales in physical stores versus e-commerce? And what do you see the trend?
Yeah, we currently do not have any e-commerce. And 100% of the sales are from offline stores.
Okay. And do we plan to enter into e-commerce or online?
Yes, we are evaluating the omni-channel model where we'll use the store inventory and we'll use all the stores as a warehouse and deliver to the same city, because that saves a lot on the return and the logistic cost. So we are evaluating that and we are working on it. So we will comment on it, I think, in the next quarter.
Okay. Perfect. Thank you so much. That's all from my side.
Thank you.
Thank you. The next question is from the line of Abhishek from ABS Capital. Please go ahead.
Hello. Am I audible?
Yes, Abhishek. Yeah.
Yeah. Just two questions I wanted to ask. One, you are telling that you from now henceforth you will go more towards contract manufacturing. So that will reduce cost, right? Is that the reason why you are doing it?
No, we have our own manufacturing units where we save about 10 to 15% on cost, but we are passing that on to the consumer. Because all the other goods are done in contract manufacturing only.
No, you told me henceforth you will increase the contract manufacturing and reduce your own manufacturing. So will it help in margins? That's okay.
No, it will be a very similar cost. There will be no change in cost. Because our manufacturing capacity is constant and now we are increasing sales. So the contribution of manufacturing will keep going down as we are growing. That's what I said.
Okay. Just another question. Your growth is very nice. So just wanted to know, how you are competing with the online competition. Are your customers different from the ones who are doing online shopping? If you are supplying to those people who are one strata below, is my understanding correct?
So you need to understand the economics of online retailing. In online, if you're selling at the ASPs that we want to sell at, that we are selling at, that is around 250, 260 rupees, then you need a markup of more than 150%. So suppose you have a product for 150 rupees, you have to sell online for more than 350 rupees to actually make any money on it because of additional logistic costs, return costs, COD costs, RTO costs. So there are a lot of costs associated with online retailing that doesn't allow people to sell of such low ASP products. That is why internationally also Primark doesn't sell online and a lot of value retailers don't sell online because it's not economically feasible. So we don't, I wouldn't say that we are in direct competition with any of the online retailers, because most of the products that you're getting at this price is usually 2 or 3 seasons old for brands, or it's a much lower value product than what we sell in our stores.
Okay. Thank you.
Thank you. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you. Thank you for the opportunity and congratulations on super set of numbers. I have two questions. One is I wanted to know your seasonal distribution of sales. And second, you mentioned that some stores are doing much higher sales. So if you can provide some idea on, what are your highest selling stores and how many as percentage of your total number of stores, what would that be?
Can you repeat your first question, please?
Seasonal distribution of sales. How much do you do in Q1, Q2, Q3, Q4?
So because of the Hindu calendar, the festivals keep on changing, the dates keep on changing, so it's very variable. So if Durga Puja happens later, then the percentage of sales in quarter 3 increases. But there's a lot of disturbance from your line.
Yeah, I'll put myself on mute.
Yeah. So talking about the contribution, it varies according to the Hindu calendar festivals, but the highest sales are in quarter 3, then second is quarter 2, then quarter 1, then the lowest sales are usually in quarter 4. So that is how the seasonality is impacted. And what was your second question?
I wanted to know your per square foot sales. You mentioned that some stores do very high sales. So, what is the highest that you do in terms of, for a full year, for full last year? What is the highest per square foot sales at least? And how many stores would cross the benchmark of 1,500 rupees?
I'll have to check the exact number, and we don't share the exact number, but we do have a few stores that do annually more than 1,500 rupees per square feet of sales.
Okay, thank you.
Yeah, thank you.
Thank you very much. The next question is from the line of Khadija Mantri, Capri Global. Please go ahead.
Good afternoon, sir. My question is on the competitive intensity. So Reliance has also launched its affordable clothing brand. So do we compete with them, or the average selling price is much higher in those type of stores?
I haven't personally visited, I think it's called Youth Star, but I think it's in the similar price range of Zudio, which is higher than us. But like I said, the market is big enough to actually accommodate multiple retailers. So this is not a cause of concern because more and more people will enter this because this is such an attractive space. So we are focusing on making ourselves strong enough that we don't have to worry about competition.
Okay, so but Reliance is known to be a little aggressive, when it comes to pricing or capturing the market share. So what are your thoughts on that?
So I would say like even Zudio opened 200 stores last year, and they have opened a lot of stores in the same area where we are present, but we haven't seen any sort of impact in sales. So even if Reliance is being aggressive, I think our growth expansion strategy is also pretty aggressive. So if we focus on doing the things that we've been doing right, then again, like we're focusing on ourselves.
Okay, sure, sir. Thank you so much.
Thank you.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Prathamesh Diwar from Tiger Assets. Please go ahead.
Yeah. So just if I missed it earlier, a couple of questions. As if plan to open 50 to 60 stores, so how much investments is going to be there to open this 50 to 60 stores? And my second question is, if we open a store, let's say today, so how much time it will take to reach the revenue per square feet of 1,000 rupees?
Okay, so answering your first question, we plan to open 40 to 50 stores, and the investment required for that is around 110 crores, which we will be completely financed through internal accruals. And second question, when a new store opens, how much time it takes for it to reach 1,000? So again, it completely depends on the company base. If you spoke to me last year, I would have said the store will take 2 to 3 years. If you talk to me this year, I will tell you that it's 1 to 2 years. And maybe next year, if we continue this growth, then the new stores from the first month itself are doing 1,000 rupees per square feet. So it depends on the company base because it's like 15 to 20% lower than the company average.
Okay. And just a last question. I think you said we are expecting 30 to 40% revenue growth and around 4.5% of PAT margins for FY'25, if I'm not wrong.
Yes.
Okay. Thank you, sir. All the best.
Thank you.
Thank you. The next question is from the line of Prerna Amana from PNARS Partnership. Please go ahead.
Yeah. Hi, sir. Congratulations on a good set of numbers. I have two questions. So first of all, when it comes to manufacturing, what percentage are you getting manufactured in-house, and how much are you giving it for like a third-party manufacturer?
So 16% of our sales are manufactured in-house and 84% is outsourced.
Yeah, and this will reduce as your scale of operations increase, right?
Yes.
Yeah. And the last one is, I think in your beginning comments, you told that 80% right now of your sales through your proprietary brand. So are you telling me that the rest 20% that is there, you're selling other people's brand in your stores?
Yes.
Yeah. Okay. That's it. Thank you so much.
Thank you.
Thank you. The next question is from the line of Virendra Bajaj, individual investor. Please go ahead.
Hello. Hi, sir. Congratulations on a strong result. I just had a few questions. What sort of inventory turnover in times are we looking at for this year and the next year?
So the target inventory number is 90 to 100 days that we're looking at. And going forward, we would like to reduce it to 80 to 90 days.
Okay. And you said that you have increased your private label sales quite a bit. So what sort of extra margin are you getting in private label sales versus the third-party brand sales?
So we do not get any extra margins because that is our strategy. Whatever benefit and cost we get, we pass it on to our consumers.
Okay. And if I can just understand what sort of revenue per square feet are we getting from new stores like that we opened in the current year or within less than 1 year?
We don't share those exact numbers.
Okay. All right. Also, another question I had is that when I was looking at your pre-Ind AS console numbers, you have reduced your other expenses by almost 3% of revenue. So just to understand how that was achieved by the company.
What have we reduced?
The other expenses in the pre-Ind AS console numbers for this quarter.
Yeah.
Your other expenses have gone down by almost 3% of sales.
So that's because the sales have gone up. Like I said, it's a fixed cost business. The rent is always going to be 54 rupees per square feet, even on 800 rupees per square feet of sale and even on 1054 rupees square feet of sale. So if you look at it, the per square feet of sales have risen almost 33%. So of course, cost as a percentage will come down.
Okay. And while we expand more stores in the current geographies, are we planning to open more in cities or more in the smaller towns?
So the kind of customers that we cater to, they are present across tiers. We have around 3 stores in Delhi also, and they are also doing reasonably well. So we are targeting tier 1, tier 2, tier 3. Wherever we get a good enough site where we think we can achieve those sales at our cost.
Okay. And so just one last question. What is the sort of payback period that we have for our new stores that we are opening now?
It should be around, I think, 3 years.
Payback period?
Yes.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Naveen Baid from Nuvama Asset Management. Please go ahead.
Thank you for the opportunity again. If I look at your numbers historically, your depreciation used to be about 1 to 1.5% of your top line. Now, if you strip off the depreciation on ROU assets, is the depreciation going to be around similar lines, which is 1 to 1.5%?
Yes, it's going to continue to be that in pre-Ind AS numbers.
Okay, thank you.
Thank you so much. Ladies and gentlemen, due to time constraint, the next question will be the last question. The next question is from the line of Manoj from Kiva. Please go ahead.
Yes, sir. Thanks again. Sir, if you can share some details on Zudio. As you said, Zudio has opened a store near you. If you can share how near, and in case of any research, that why has that impact not happened? I think you said that ASP is much higher than ours, but as you said that T-shirts start at a lower price. If you can just share more color, so we will not be as so if you can just address that concern that it's a totally different market. If you can share that. And also the 54 rupees would have an escalation clause of 5% a year. And
yes, the average is 5%.
Yeah.
And there are some Zudios within 1 kilometer radius. There are some within 5 kilometer radius. And we do some sort of benchmarking in terms of competitors for all our stores. But what we have found out is, our kids wear contributes almost 26% of sales. So we have a lot of family customers coming into the stores, whereas Zudio's kids wear is almost non-existent. So I think one big reason is that, and the second reason is, like I said, it's a completely different target customer with very little overlap. That is why I think we haven't seen much impact on our sales in those particular stores.
And that low overlap is because of the product fashion trend or the price point or both?
I would say price point, because even in our stores, if we usually when we study the parking space, it's usually two-wheelers, and we don't have a lot of four-wheeler owners as customers. Whereas I would say, like, if when we visited Zudio, it has a lot of four-wheeler owners also. So there's a change in the target customer.
Got it. And if we look at the just feeding the numbers you're sharing, kind of the ROE is coming much higher than 22%. It's probably inching to in the 30s. Also, the payback period is not looking like 3 years. If you just look at what we have, is that okay? Where am I going wrong here?
We like to under promise and over deliver. So we are happy with a 20% ROE also. Like if we get more than that, then good enough. But the guidance that we give going forward, like even if you're getting an ROE of 20 to 22%, we are happy with those numbers.
Right. And can you share something 110 crore for store capex? What was that number? Something.
So that 110 crores is total investment. Out of that, the capex would be about 40 to 50 crores, and the rest would be for inventory, working capital.
And this 110 will be spent over the next 3 years?
Over the next 9 months.
9. All right, sir. Thank you so much.
Thank you.
All the best.
Thank you very much. Ladies and gentlemen, I would now like to hand the conference over to Mr. Akash Agarwal for closing comments.
Thank you everyone for joining on the call. We hope we have been able to answer your queries. For any further information, we request you to get in touch with Marathon Capital, our investor relations advisors. Thank you and have a nice day.
On behalf of V2 Retail Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.